I'm Charlotte McLeod with investingnews.com, and here today with me is James Henry Anderson, Senior Market Analyst at SD Bullion. Thank you so much for being here. Really good to have you.
Charlotte, it's great to be back.
Really good to be catching up with you. We last spoke almost exactly a year ago, and you told us at the time that 2000 was just a beginning for gold. And certainly we're now seeing that play out. So I'm hoping you can help us make sense of some of the dynamics we're seeing for gold recently. So we finished last week with gold briefly going above 2,400, then it pulled back, and we're still now below 2,400, although we're pretty close. So for you, what was driving that move past 2,400 and now the pullback that we've seen?
Yeah, so last time we spoke, obviously gold was resistance at 2,000, and it was coming back and forth and kind of fighting with that. And a year's passed now, and 2,000 really seems like support. I believe the 200-day moving average is now clear over 2,000. And so, looking out at why that's happened and the dynamics involved, it really feels like tectonically underneath things are changing in a way where we're looking ahead at one of the biggest secular bull market mania phases for gold ever in history. I mean, it sounds a little bit hyperbolic. If you look back at like the late 70s version of that, it was mostly Western driven in the derivatives markets, whereas this time you have it happening physically and derivatives as well, on a global basis. So, $2,400 gold, it sounds like a lot. I suppose to people who are kind of used to these suppressed commodity prices, given the system that price discovers them. But ultimately, I think 2,400 is going to be looked back in time as being cheap. The thing is that gold can be pretty volatile. If you look back at 78, in late 78, I think gold had $200 an ounce as their resistance, and then it became support. You had a situation in late 78 where it ran from 200 to 250, and then over a 30-day basis went from 250 back down to 200, tested that support, and then 4x'd within about 14 months following that. I don't think we're going to have anything that dramatic happen in 14 months, but I am suggesting that it is going to likely occur again where you'll see, take the zero away from the $2,400 an ounce gold, and you're back at the 1978 nominal prices. For me to see it test 2,000 again, and then eventually in the long run go beyond 8,000 would not be surprising, just given the dynamics of what we're looking at.
Yeah, okay, really good to get your perspective on what's going on here, because when I look at mainstream reporting on what's going on in gold, there's a lot of pointing to tensions and conflict in the Middle East. And I know we've had some commenters here on our channel ask, why aren't we talking about that? So for you, to what extent is that playing into what's going on? Is that a major factor, or is it these more ongoing large trends that are key for gold right now?
It's definitely playing into it in the sense that, anytime there's geopolitical uncertainty, any uncertainty is good for gold, really. And in terms of underneath, I'm talking in like a bigger term of the preference of bullion over bonds, looking straight down the barrel of a secular bond bear market that's going to run for this decade into next. We're talking about a situation where you have so much capital and hot capital that can flow into various sectors, such an underweighting of commodities in terms of the high net worth investment class and the institutional side. When those funds start flowing in because they realize things have changed and we're moving out of a tech bubble into a commodity super cycle, you'll have massive inflows that are coming into the commodity sector, and a lot of them will drive into silver and gold, because this is what we're looking at is most likely going to become a store of value crisis over time, and a supply side crisis where you're going to have a situation where there will be fits and eras where getting bullion, in size will be very, very difficult to do, especially on the silver side, but even in the gold side, depending on how acute the crises can go.
Okay, really interesting. And we'll come back to, I think, that supply side angle in just a moment. But one of the things we spoke about in our last conversation was that ongoing trend toward de-dollarization. And I know that's a really big topic, but it seems like it's very important, especially the way you're looking at things. So what key developments have we seen over the last 12 months?
So you see a lot of buying from central banks, right? The last 2 years, you've had record buying. And I'm talking over 1,000 tons, and that's what's admitted, right? And if you look on a historic basis, post-World War II, the size and scale of those two bars, when you look at it on the long-term charts, it dwarfs everything in the past. So something changed And it's become obvious, and I think in the Eastern world, that having gold in their sovereign savings makes complete sense. China's probably leading the way, but there's a lot of other countries. I mean, even in the EU, you have Poland out there buying in heavy volumes, right? So it's not simply just an Eastern-driven thing. There's also Western countries that are doing it, and this is on the central bank front-running the crowd scale. The central banks are the ones, by their actions, doing this. They'll tell you so many things in so many ways in words, but you don't really have to believe them much. Just watch their actions. And I think what you're seeing here is just simply them front-running the eventual trade of high net worth institutions running into bullion and other retail investors, et cetera, going into every type of, from bullion all the way to miners to derivatives. Everything will see inflows.
Okay, yeah, definitely. I've been hearing so much about the central bank buying trend, so that's been very interesting to watch. I want to ask you about another gold price driver that I have been hearing a lot about over the last little while. So, of course, everyone is watching the Fed very closely. And for a long time, I was hearing, well, gold will really take off when the Fed starts to cut interest rates. And of course, we haven't seen that happen yet. And it seems like it's even getting pushed further out down the road than we may have expected. So I wondered if you could weigh in on that and, watching the Fed, how important is that for gold at the moment? It seems to be doing fine without any Fed cuts.
Yeah, and as well, just you look at prior cycles, gold typically front runs the Fed cut, right? So gold's it's going to make major moves a lot of times before that even happens. It starts getting priced in. And I think what you're seeing is a little bit of combination of that, as well as momentum traders kind of piling in on the long side and just taking those quick profit scalps that they can on the long side. So it's a combination of a few factors, but ultimately, in the end, it's basically a situation where you'll have people who come into the market for short-term, medium-term trades, and then the longer-term steady longs will probably be consistently winning over the next 5, 10, 20 years.
Okay, and I wondered if you could give me a little bit of a roadmap for gold in 2024. So at the beginning of this conversation, you mentioned some pretty high price targets that we could see down the road. So, but in 2024, what are we looking at? And how can investors, I guess, play this situation? Because it's getting very interesting. I think people are looking around and maybe not knowing quite what to do.
Yeah. I think first and foremost, for me, is I've always been first and foremost foundationally, you should own a larger position of bullion than most likely you've heard people say. In terms of your liquid net worth, I think having a fifth, 20% of your liquid net worth in physical bullion makes total sense. You can get even more aggressive if you want to go into miners and other things that are a little bit more risk laden. But that number is not just pulled out of thin air. If you backtrack data and do back testing from 1968 till now, so basically the full fiat currency era, and the risk reward for owning bullion throughout that entire time frame, especially gold, has been pretty good in terms of its performance relative to the S&P 500 or to U.S. Treasuries and bonds, et cetera. So what we're looking at here is a situation where the S&P 500 is in bubble territory, completely overvalued on a long-term basis when you look at the value over long term. And then the bond situation where the U.S. Treasury is ultimately going to probably have to nationalize a lot of things and going to have to force citizens. So they're going to mandate that citizens end up buying the U.S. debt. You're going to have a big change in the banking system coming out with the CBDC grid coming on. I would imagine there'll be massive consolidation, and you're going to have forced probably treasury buying on the banks as well as the U.S. citizenry. So you're looking at major underperformance in terms of bondholders, in terms of real value, what they're going to get. They'll give you maybe 8, 9, 10% on the 30-year or 10-year. But in real terms, when you have inflation running at 20% and they're lying to you the entire time, you're going to be underperforming 10% year after year after year, right? So that's the situation we're looking at. It's a world that's changing, and it's going to be a lot different ahead in terms of what we've seen the last 5, 10 years.
Yeah, I think that one thing that has been ingrained over me over the years, it's if you have a very high gold price, like you had mentioned, possibly an $8,000 gold price, what's going on externally in the world that is making that happen? So anything more that you would say about this situation that we could see coming up?
Yeah, there's been a lot of different things over the history that have kind of shown that there's times and frames. We've only lived the last 50 years where the world has been running on a full fiat currency standard. And before that, gold had been pegged at a artificial price. And John Exter was a former central bank governor. He drew a cartoon in late 1968 that showed an inverse pyramid with gold at the very bottom and all the derivatives and everything, every other asset class built at the top. And during spillover events or any type of secular change or structural change, you're going to have a lot of the value come back down toward that bottom pile of gold. And I think that's what we're going to be going through as we structurally change and relearn the fact that gold is the foundation of everything. And in terms of, finance, it's basically everything has mushroomed off of that. And we're going to go back to a situation where gold is a key asset in virtually every, and not simply central bank sovereign balance sheets, but it's also going to be on high net worth investors' balance sheets. It's going to be on the balance sheets of virtually everyone in the world. And that's how you get to a situation where you have a bullion market mania and you have a price that goes up way higher than it ever was thought to be allowed to go, right? And at some point you start to revalue it to a certain extent. I don't even care about the fiat nominal value, really. I care in terms of relatively what it'll buy you in goods and services and how many shares of the S&P 500 it gets. I mean, it's very obvious to me that we're going back to S&P 500 being in parity with the gold price, right? The S&P 500 is over 5,000 roughly, so gold's at 2,400. Gold's going to double at some point in terms of relative value for the S&P 500, and it's probably going to outperform because if you look on a long-term basis, there's been sharp eras of that happening, especially during commodity super cycles where gold vastly outperforms the S&P 500. And I think, for bullion holders from here to there, you're going to be able to afford yourself a lot more S&P 500 or various U.S. stocks if you hold from here to there and take profits at certain points along the way.
Okay, and so lots of good thoughts on gold there. I want to make sure that we also go back and take a look at what's going on with silver. So silver also recently, some exciting price action. I believe we got almost to $30 recently. But unlike gold, silver it's well away from its all-time high. So I want to ask you, I guess, we tend to hear that silver lags behind gold. Is it now getting ready to take its cues from gold?
Yeah, so typically in major bull market moves, gold leads first, and that's typically what you want to see. And you want to see silver take its time and almost torment silver bulls in the sense that they'll be griping about it, not catching up with gold. But then eventually it starts to catch up, and it does it very rapid fashion. Right now, I think the gold-silver ratio lasts like in the 80s, right? And on a historical basis, that's rather high. I think last time we made a run at 30, it was 2020, 2021. And the gold-silver ratio dipped down to the low 60s when that was happening. Now, here we're at the same point where it's trying to bust through 30 and the gold-silver ratio's up in the 80s. So the potential for silver to run, in terms of price and relative value to gold is rather strong right now. And if you look at a technical chart of the gold-silver ratio, it looks like if it falls off the cliff, it can really go for a good run here. And whether or not that's going to happen this year, that's hard to say. I'm not sure exactly when we're going to get through 30, but I am sure we are going to get through 30. And once that happens, you're going to get momentum longs piling in the silver trade because once it gets beyond 34, the run into the mid 40s is kind of an easy scalp for any momentum long. And, I personally would probably do a short, medium term trade on something like that. To me, that's a no brainer. Once you see silver pop beyond 33, 34, you hold till mid 40s on a short, medium term trade, something that lasts maybe 6, 12 months, something like that.
Okay, really interesting. And, for you, how much do you weigh silver's industrial side when you look at silver? Because I get varying responses when we talk about precious versus industrial when it comes to silver.
I do a lot in the sense that it's gobbling up all the supply that's pretty much available. And, with the spot prices as low as they are, it's kind of this duality between people who look at spot price for silver at $29.30 and think that that's a properly discovered price. And I would argue that is a suppressed price that by the system has basically kept it in a level that's we're just half off its all-time nominal price high from 1980, and we're talking in terms of 2024 fiat U.S. dollars that have devalued rampantly for the last 50 years compared to that time frame. So the amount of potential for silver not only to get to 50, but then finally get beyond that and start running is already loaded in the system. And you have this sector in terms of industrial demand. I mean, the amount of demand that's required for solar, for all the green energy batteries that we're trying to create, all that stuff's coming on at the same time that we're staring down a situation where there's going to be a store value crisis. You have people piling into gold. Eventually, nominally, gold's going to look too expensive. So people even in Asia are going to start drifting into silver. You'll have people in India piling into silver. You'll have people even in China piling into silver, or in other smaller Asian countries. It's not just simply a U.S. thing. The U.S. is dominant in terms of the silver market and investment demand side, but there's going to be a large flow, not simply from the United States, but also around the world. You're going to see people moving into silver just because gold is nominally super, super high.
Okay. So quite a situation building there. And I do want to talk more about supply and demand because, of course, ST Bullion is a precious metals dealer. So I'm curious about what you're seeing right now from people with gold so high and silver on the move. Are people wanting to buy? Do they think prices are too high? What sense are you getting?
So on the gold side, I think you're seeing some people kind of waiting to see how this goes. There's no FOMO just yet. You'll start to see FOMO occur when you get beyond 3,000. That really starts running up walls. You're going to start seeing people who realize I don't have any gold and I better get it now before it's much more expensive. At the moment, you have mostly people who are, there's some new investors, but most of the people here are steady investors who've been buying consistently, adding to their positions. As silver, gets toward that potential of jumping through 30. Once you get beyond 30, then you're going to get a new crowd of interested investors coming in and learning the story. In terms of overall demand, it's pretty robust. It's been about the same clip as 21, 22. Only 23 outdoes what we've been doing in terms of volumes. The reason being the banking crisis, more or less, so that spring really shook a lot of people. And, we still have a banking crisis ahead. It's just inevitable, I think, just given all the factors that are building. Not just simply commercial real estate, but there's other factors involved as well. So the situation is the premiums are good. At least they're pretty competitive and thin. They're not as wide and gapped out as they were during the COVID era. So people who are getting into silver, for instance, you can get 10-ounce bars for just $1 or so over spot if you look around and do some shopping. So that's mainly what we're getting. We're getting a lot of consistent regular buyers who are coming in and buying, and who are encouraged by what's happening with the spot price. And that's basically what's been going on thus far this year.
Right. And if we go back to what you were saying earlier about supply potentially getting very tight in the future, are we talking about a situation where it's hard to get metal, but if you want to pay the high premiums, you can? Or will it be more of, there's just nothing available and you cannot have it?
So there will be a combination of both. On the investment side, like you described, there'll probably be a lot of demand and it'll be difficult to serve. The only way to do that is by having a spot price that's going up, but obviously the premiums on these products are going up as well. And that way you can at least defend some of your supply so you don't sell out too quickly. On the industrial 1,000-ounce side, that'll be very, very difficult for them to keep up in terms of overall demand. I mean, you had I think Silver Institute today came out saying this year, I think the deficit is going to be forecasted around 250 million ounces. And that in 2020 is the only one that supersedes, according to their word. I think they said 300 million ounces. So it's like 4 or 5 years in a row of massive deficits in terms of the supply demand side. And at some point, we're going to hit the wall in terms of what's available and what's being demanded. And the only way to meet that is to get spot price climbing higher, so you get a lot of secondary product coming back into the market. And some of that secondary product will turn into industrial side. It'll get recycled and refined. Not even refined, because most of it's 3.9 fine. We're not talking about the 1960s version or 1970s version of the silver bull market where 90% scrap came in and old 90% coinage came in. Now, most of the silver inventory that's going to be coming in is going to be old 3.9 fine silver that people have been hoarding, say since the 80s. They were part of that bull market, and it took a long time for it to come back, and now they're just ready to offload that stuff. And so, so anywhere near $50, they're fine. They'll just sell it, and that'll be that. Then that stuff will end up in solar panels, and that stuff will end up in cars. But ultimately, I'm talking, looking out even further, of like, silver running to 75, even triple digits, I think is inevitable as well in terms of per ounce price at fiat dollars. And that's within a 5 to 10 year range. I can't imagine it not doing that, given all the dynamics that are going on.
All right. And you touched on this a little bit earlier, but for people who are looking to buy physical gold and silver right now, do you have any tips in terms of how they can get the best value? Because Of course, although prices feel high right now, it sounds like they will go much higher. So still an opportunity.
So like, for instance, I brought a little show and tell here. Like, this is a 10-ounce silver bar, right? Look how tiny that is. You could buy these probably just over $1 over spot and stack them somewhere in your house and put them away and forget about them for a while and then come back and the spot price is doubled or tripled. And if you want, you could take and sell a few of them at your local shop or to a dealer like us. But these things are generic little 10-ounce bars, and you can get them just $1 over a spot. It's no problem. You can also get them in round form, which is privately minted, small 1-ounce size typically. Or you can get sovereign coins like a silver eagle or a silver maple leaf. Those are usually a few bucks over spot, but they're a little bit more demanded in terms of the industry and well known and recognized because it has a government stamp on it. It's legal tender in the respective countries. So it's a combination. It really depends on your objectives. If really getting as many ounces as you want for your currency, I think the best bet then would be probably bars in sizes of, I think 10 ounces is pretty nice because the size and increments are pretty good. You could go even larger. You can get 100-ounce bars. But those things you can easily stack and store a lot of value in a small space, and you can that's an easy way for people to discreetly hold some in their house, and even in non-bank storage we offer that as well. And there's other services out there that offer that too. It's something that has grown a lot in the last 12, 15 years as I've been in this industry, in the sense that people not only keep it in their homes, but they'll also keep it with a Brinks or a Loomis in a segregated, storage account. I personally do that myself for a portion of my holdings. So it's common, and people put them in IRAs and other things like that as well. So,
Okay, another related topic that I wanted to just briefly get your thoughts on is, I keep seeing these headlines about Costco selling gold and silver, and I wondered about your perspective as a precious metals dealer. Do you think is this good in terms of, more people are seeing it, maybe they're getting into it, or what are your thoughts there?
yeah, so I'm sure that confuses people who aren't in this industry to understand the dynamics at play. My hunch is it's one of our competitors who more or less has an Indian investor who came in and bought a large portion of their business and is now funneling a lot of their product through them through Costco, right? So it's like multiple chains of the way that these products are being brought to Costco. As well, Costco has these Visa cards, right? If you have a Visa card and you're a member, you can get like massive kickback. I forget the percentage, but it's like 3 to 5% kickback on your purchases with these cards. So what you have there are a lot of people who know these, who know that the gold bars are available at a really good spot price. Plus, they're going to use the card for the kickback, and they're going to get gold almost at spot, right? I mean, they're going to get a price that's really, really good. The issue being that once it goes up on their website, it gets sold out like that because there's tons of people who already are in on it and know what's happening. So yeah, nominally it sounds like a lot, 200 million in a month, but in the grand scheme of things, 200 million a month is nothing on the North American side in terms of overall revenue that goes on in the bullion industry. So it's nice for Costco. It's good to get headlines and such. It's nice in the sense that it gets people to understand that this is happening and that this is actually being driven by mainstream investors mainly that are out there buying it for the long term. That's all great stuff. But in terms of the scope of what's really happening underneath and how the dynamics are at play, at least I can give you some coverage and understanding of what's happening.
Yeah, okay. Interesting to go into that. Some tricky points there that I was not aware of. All right. I think that we've covered a number of the points that I wanted to ask you about on gold and silver, but I want to put it back to you and see if there are any other elements that you're really watching right now, things that you think investors should be aware of.
Yeah, I really, I always like to try and keep a long-term perspective. I think in the shorter term, you could have a situation where gold could run to 3,000 an ounce this year, depending on how this plays out, how things go for the year. But on a longer term perspective, it's really, I try and measure things in terms of silver and gold versus the relative purchasing power of asset classes. So like, for instance, I mentioned the gold and S&P eventually meeting 1-to-1 and then eventually gold going beyond the S&P 5,000 in terms of nominal price. So S&P is 5,000 roughly right now. To see gold go to 8,000 at this, at some point in terms of relative value, that's coming. It's just a question of how many years and what are the dynamics at play. But I think long term on a chart, you can kind of see that. It's just the way that markets move. they go up into a situation where it's gone crazy in one way, and it'll go down and go crazy in another way. And that's where we're headed. We're going back down toward the crazy commodity super cycle spike low in terms of S&P's performance versus gold. So it really is a question of understanding that yes, things are changing underneath structurally. Things are going to change in terms of capital flows, in terms of positioning overall in the world. And you kind of want to get ahead of that. You know, you don't want to be late in that. You don't want to be one of those people who comes chasing at the end and buys when it's overpriced. You want to get positioned ahead of time. And I also think one thing that people need to consider too is just this is not like a situation where you need to put a lot of risk out on the table. I understand people like the idea of miners and such, but there's a lot of risk involved with mines in gold and silver. And there's also risk in the terms of they've underperformed bullion since 2007. And I don't see that it's just overall. There's been a couple blips of time where they've outperformed bullion in short time frames. But if you look at the general trend overall, they've gone down in a U shape since 2007 versus bullion, how they perform. That U shape eventually will come up, but it could take 5-10 years or so. And we're talking about a change in the world where jurisdictions are going to get a little bit nutty, and mines are going to get closed or nationalized, or it'll be very difficult to mine because people aren't putting up with that in their backyard. So things like you've seen, for instance, in Panama. I mean, I live in Panama. I saw that firsthand, what happens when people get uppity about mining in their country. I've had a miner in Russia that got confiscated. That's, you know, the shares are sitting with the U.S. Treasury now. I can't touch them, right? So these are moments in time that are lessons to know, like, okay, maybe I'll just stick with bullion for the longer haul and not start speculating too much in miners. Maybe later on when the speculative mania starts going nutty, then it'll be time to start throwing darts at the board and hoping that you hit. But in the meantime, my strong suggestion is that the majority of your exposure in precious metals should be in physical bullion that you own outright, outside the system, that you have direct command over, or you have a third party that you fully trust that's not involved with the markets at all, that's simply just a storehouse or logistics trader, not a trader, like a Brinks or a Loomis. So those guys they don't have derivative desks there at their storage warehouses. They're not making markets. They're simply holding the metal for you and your title and name. And if you tell them to ship it somewhere, they'll do it, right? And they'll go through a security process for it. So really it's about, the return of your capital, not so much getting risk, getting out there and putting your neck out on the line for just massive gains when things may not pan out the way you might think they will. So I think, if I look around, a lot of the griping that I see in our industry is the mining sector, right? It's the guys who have been sitting around buying all these these obviously undervalued mines, but their underperformance versus bullion, I think, continues for another 5-10 years. And I feel bad for people who don't understand the dynamics at play, but this is a bullion bull market first, and then later maybe the miners will start to catch up and outperform, but that's going to be later.
Yeah, I think that just based on what I see, I think many of our viewers will be on the same page in terms of frustration about the miners. Was that 5 to 10 years still of underperformance for the miners that you had
I
just
think
mentioned?
so.
Okay.
I think so. There'll be fits and starts where some miners will do well, and you'll see people out there on social media bragging about how their one miner did great versus bullion. But in the general trend overall, if you look at the various sectors globally, I'm not just talking about the United States, I'm using the entire world, like Australia and the United States and other major mining sectors compared to how bullion has performed. Over 2007, if you look at like a long-term chart, we're in like a U cup and we're still at the bottom of the U. Eventually it'll start coming up, but that could be a while. And in terms of this, just the geopolitical tensions and the stuff that's happening on the national scale in a lot of these countries, there's just a lot of risk, I mean, people, they like to have a miner in North America. Okay, it's probably a lot more safe of a jurisdiction than, say, somewhere in Africa or South America. But I'm just suggesting that overall, people really need to think through that this is a major change that we're going to be going through, and you kind of want to make sure the majority of your pile is something that you control outright.
Okay, yes, certainly. I think many people will be on the same page. And I have just one final small question before I let you go, which is, this is all starting to sound very inevitable. It feels like we're on course here. Is there anything that throws us off this track that gold is on? Is there anything that could happen that would send us in a different direction?
Sure. Like a solar flare or maybe some type of asteroid. Or like a deflationary nightmare that they can't get a hold of and they can't cue either way out of, perhaps, but I don't see it. I think the world continues on. This is the thing. I know it sounds scary to say $8,000 an ounce gold. What's the world look like? What's the cost of a loaf of bread? All that kind of nonsense. Look, gold went to 850 in 1980. Okay, the price of a loaf of bread at your local grocery store didn't go through the roof. Okay, things sometimes they restructure, and the market will revalue certain things based on the dynamics of that market at the time. That doesn't mean the price of your bread at the local grocer is going to go through the roof, right? So you can have a situation where gold gets a premium, silver gets a premium because of the dynamics at play and because of the dynamics that have been building for decades. But you can also have a situation where you can afford your groceries, right? So we're going to go through a weird time where things are going to get more expensive because we are going to go through a secular inflation, and there's going to be weird dynamics in the sense of there's going to probably be a CBDC system where they're going to be giving stipends out to people just so they can make, so there's no riots in the streets and stuff like that. But the world won't end. The world just changes and moves on into a new system and a new day. And so I think you just got to have to kind of be ready for that. And if you're ready to see probably the craziest stuff you've seen in terms of change in the financial markets in your entire lifetime in the next 5-10 years.
Okay. Thank you for humoring me on that question. And, people tell me I'm very serious in these interviews and I never laugh, but that did make me laugh. So I think it's a good place to end.
Glad I got you to laugh. That's good. It's a little bit of levity, never hurt anybody.
Exactly. Okay. Well, thank you. Thank you so much for coming on to go over what's going on in gold and silver. I think this was a really good overview of your thoughts and what could be coming next.
Thanks for having me on again, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is James Henry Anderson with SD Bullion. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.